Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Managing Director and Head of Fixed Income Research, Tom Tzitzouris. Tom, how are you doing today?
I'm doing great. Thank you for having me on.
Thrilled to talk to you. Obviously, no shortage of things to get to. So, I want to start. We're recording on a Thursday. So, the Fed met yesterday, decided to raise interest rates by 25 basis points, which some are considering a dovish hike because just a few weeks ago it was expected that it would be a 50 basis point rate hike. Inflation is still high. Fed Chair Powell said a lot at their press conference, and obviously the banking instability over the last couple of weeks has complicated all of this. I want to turn it over to you. What is your high level read on what the Fed did and said yesterday, and what does that mean for the interest rate outlook as we head into the end of the year?
Yeah, well, essentially, they delivered a 25 basis point rate hike as we expected. They made no change to their current pace of balance sheet reduction via quantitative tightening. That is, they're continuing to let Treasury and mortgage-backed securities run off their portfolio, although they are, for the time being, expanding their balance sheet via liquidity into the banking sector. So that is offsetting the quantitative tightening. So the balance sheet, incidentally, is actually not shrinking anymore. It's actually been growing, but they've committed to continue to reduce the balance sheet at least via securities held via quantitative tightening. So they've committed to that, and they've made no indication that either rate cuts or a pause to quantitative tightening are on the horizon anytime soon. That's where the Fed stands. Now, also, I should say the Fed has noted that there is incremental tightening being done simply by credit channel tightening from what's happening in the banks. So the Fed is giving a shout out and acknowledgement to the fact that credit conditions are tightening further, and that suggests that there's no need or no justification for further rate hikes at this point in time. Well, that was not exactly what the Fed said, but they more or less hinted that for now they're done tightening. The problem for the Fed is the bond market is saying, well, yes, we know that tightening is about to come to an end if it hasn't already, but rate cuts are coming very shortly, and the Fed is not committing to anything of that. So what you're finding is the bond market is saying that cuts are coming within the next, we'll say, 3 to 4 months and are likely to persist throughout the remainder of this year. The Fed, on the other hand, is suggesting that cuts aren't likely to come until the end of this year or early next year. So there is a pretty good sized disconnect between what the Fed, the FOMC, the Fed dots, and Powell's own message is saying versus what the bond market is saying right now.
Right, and obviously short-term treasury yields have been plummeting over the last couple of weeks. Those often, if not always, lead the Fed funds rate, indicating again, as you mentioned, that the market expects rate cuts heading into the end of the year. The Fed has remained firm that they'd like to get to a high policy rate and hold it there, be restrictive for a while to get inflation in check. I guess in that debate, which is rate cuts or hold firm for the rest of the year, where do you stand on it, and how does that fit in with your economic outlook for the remainder of 2023?
Yeah, well, we certainly would sympathize with the view that a recession is coming. We take that view ourselves as well, and we think that what's happening in the banking sector is going to further increase those odds of a recession this year. But with that said, the bond market is saying that the Fed is going to get weak knees and is going to abandon its inflation fighting mandate here and is going to engage in something on the order of about 150 to 200 basis points of rate cuts between now and the end of next year. And in order for the Fed to do that and to begin that this year, it really has to abandon its inflation mandate, which we don't see them doing that in the first half of this year. Perhaps they migrate away from it in the second half, but we don't see them moving that aggressively. So I think the bond market's getting a little bit ahead of itself by suggesting that Powell is going to get weak knees here and is going to cave to the weakening growth outlook rather than continue to focus on that inflation problem.
That makes a ton of sense. And I think I want to end, especially, we've talked about kind of the complicated economic moment. So I want to end with a place we often end, which is how are you positioning for this sort of environment and where are you finding value? In the past, you had recommended moving up in quality, shortening duration, and that's obviously been a tactic that has been beneficial over the past several weeks. Where are you seeing value today? How are you positioning fixed income portfolios heading into the end of 2023?
Yeah, value is beginning to emerge in the mortgage-backed security space where we had moved underweight in anticipation that banks would begin to pull away from supporting this market this year. And that's exactly what's happened as we've seen stress in the banking sector. They've pulled away from activity in the mortgage-backed security market, and you've seen spreads widening out there. So we're seeing some value begin to emerge there, but we remain underweight mortgages. And the offset to that underweight in mortgages is that we remain overweight in investment grade corporates, both long duration and short duration. We've maintained that, and investment grade corporates have performed well in 2023, and we do expect them to continue to perform well despite the stress in the financial space. We do expect spreads to remain relatively well behaved for now, but at some point in time, we're looking for an opportunity to migrate back towards mortgage-backed securities and to fund that by either moving to reduce our exposure to investment grade corporates as this cycle matures, or reduce our exposure to treasuries and corporates and move into mortgages. But before that happens, we're very likely to see spreads in mortgages and corporates widen out and treasury yields push lower, because recession is going to be on everybody's radar as 2023 continues to progress.
Certainly the case. I think it's even been called one of the more anticipated recessions of all time, because people can see what the Fed is doing and see the economy kind of slowing under our feet. So this has been really insightful, Tom. I want to thank you so much for the time as always, and hopefully we'll get to chat with you again soon as things develop, because there is no shortage of things happening right now. So thank you so much.
Yep, thank you.